We are student attorneys enrolled in the Taxpayer Clinic at South Texas College of Law in Houston, Texas. Today we are here to go over federal income tax issues related to disasters. We provide free legal representation to low-income taxpayers in the Houston area and the surrounding metropolitan area. There are many types of disasters ranging from natural occurring weather catastrophes, including fires, earthquakes, tornadoes, hurricanes, and floods, to terrorist acts. In order to qualify for favorable tax treatment, the federal government must declare the area a federally qualified disaster area. This is called a Stafford Act disaster. In America, about 90% of natural disasters involve flooding. Many flood victims do not have insurance, which usually hurricane victims do have some sort of insurance. Since we are a tax clinic located in Houston, we were compelled to create this video with the devastation that Hurricane Harvey hit our city with. Many people lost their homes due to severe flooding. The map of Texas shows the areas that were affected in red, which you can see is a very large area of a heavily dense populated area. There are two phases of financial issues when dealing and recovering from a disaster. The immediate concerns are ways to get cash, and the later considerations include dealing with the tax consequences.
One of the main ways to get cash immediately is a gift or loan from friends or family, or from government agencies. The good news is these are generally non-taxable. Money from employers is generally taxable though, unless the funds are specifically used for disaster-related costs. For example, cleanup or repair of a damaged house. If you are fortunate enough to have insurance during a disaster, there are tax consequences that can arise. This is a very complicated issue, but a general example of a non-taxable event is if you use 100% of your insurance proceeds to either pay for repairs to your home and/or medical bills related to a personal injury. A couple of examples of insurance proceeds that would result in a tax consequence are casualty gains, which will be discussed in detail later. If you fail to use the insurance payments for disaster-related repairs, the IRS will consider this taxable income. In the event of a federally declared disaster, the IRS may extend the deadline for filing returns and waive certain fees. The IRS website provides additional details.
An important deduction a taxpayer who has been in a disaster area should consider is the casualty loss or personal property deduction. To claim this deduction, there must be a casualty. A casualty is damage, destruction, or loss of property that results from an identifiable event that is sudden, unexpected, or unusual. The type of property must be personal property, which is property not used as part of your trade or in a business. Several types of disasters mentioned earlier can qualify as an event. It is very likely that the IRS will ask you to prove the claim in an audit. There will be two things they want to see. One, that there is a casualty, and two, that you can support the amount you claimed as a deduction. To accomplish this, first, prove that there was an event. Second, you need to show that the event actually caused the damage. Next, you need to prove by original documentation that you own the damaged property at the time of the disaster. Finally, you want to show a claim for reimbursement with reasonable expectation of recovery. The first step in calculating the loss is to determine the adjusted basis in the property. Unless the property was acquired by gift, devise, or divorce, the adjusted basis will be the original cost. Next, you want to determine the amount that the fair market value of the property was reduced as a result of the casualty. The lower amount between the adjusted basis and reduction of fair market value will determine the dollar amount of your deduction. You would take the lower of those two amounts and subtract any insurance payments and other reimbursements received. The resulting amount is the value of your deduction.
Reconstructing business or personal records can be a daunting and difficult task following a disaster. However, this is important for record keeping, compliance, and future audit purposes. When dealing with disaster victims, the IRS may consider documentation requirements satisfied by the best reasonably available information presented in good faith, when it is not feasible to obtain documentation to recreate lost records. When reconstructing personal residence and real property records, consider taking photographs as quickly as possible and checking with banks, the IRS, the courts, and other offices for documentation. When reconstructing vehicle records or personal property records, consider checking for comparable advertisements. IRS resources for disaster victims are listed here, and the links are provided below. Additional online resources are listed here, and the links are provided below. Thank you for watching. This presentation has been prepared by student attorneys of the Taxpayer Clinic at South Texas College of Law, Houston. All links from this video are provided in the comments below. If you have questions or are seeking assistance, please contact our Taxpayer Clinic at 1-800-646-1253 or taxclinic@stcl.edu.